From the Credit Union National Association, this is the CUNA News Podcast. Credit union people, credit union ideas.
Welcome to the CUNA News Podcast. I'm Associate Editor Brock Fritz, and we're spending this episode diving into the current economic landscape and lending outlook. Many of the questions credit unions started the year with remain midway through 2023. Will there be a recession? What will it look like? Will interest rates and inflation ease? How will these factors affect credit union lending and the demand for loans? CUNA Chief Economist Mike Schenk joined the podcast to answer all those questions and give the lending outlook through the rest of 2023. Mike discusses the CUNA Economist's recent quarterly forecast, the economic factors at play, the odds of a recession, the job market, mortgages, auto loans, and everything else that came up in our May 23rd interview. So let's get to Mike and hear what he and the rest of CUNA's economists expect out of the second half of 2023. Yeah, I kind of figured we're almost to the halfway point of the year, so kind of touch base and take stock on the lending landscape, how it's been for the first few months and how it's looking for the rest of 2023. First, where are things at? What's your general summary of the first few months of 2023?
Well, we've seen a very significant deceleration in loan growth overall. Not surprisingly, the market interest rates have come up dramatically. There's a good deal of uncertainty in the marketplace at the moment. Still have some troubling supply chain issues. And, 2023 looks a lot different than 2022. Overall, last year, credit union loans grew by nearly 20%, just a hair over 19%. And this year, we just put together a new forecast, our quarterly forecast. That forecast really, I would say, in a lot of respects, represents a kind of a reversion to the mean. And by that, I mean that we're expecting loan growth to be a lot closer to 7% this year than 20%. In general, when I think about the economy, we're looking at a tremendous amount of uncertainty from an economic perspective at the moment, late in May as we speak. The other thing that we're very concerned about is what's happening in the banking world and the fragility of the banking system. We do know that the Fed and the FDIC, the Treasury Department, they acted forcefully and they acted very quickly. It feels in a lot of respects like things have stabilized, but I'm not entirely convinced that we're out of the woods yet. So that could be really impactful. Actually, I've seen some estimates in terms of what's already happened that suggest that purely from an economic perspective, the pullback in bank lending that's a consequence of the Silicon Valley Bank and related issues, that the pullback in lending generally in banking is roughly equivalent to a situation that would exist if the Fed had increased rates by 75 to 100 basis points. So that again represents a really significant drag on economic activity overall, and again has implications for the labor market as well. We do think that the Fed will have inflation under control. We have CPI year over year coming in at about 3.5% at the end of this year, which of course puts it, if we're right, that puts that reading above the Fed's comfort zone, which is closer to 2%, 2 to 2.5%. But we do think that by the end of next year, CPI will be reflecting a 2.5% year over year increase. So pretty much where the Fed wants it to be. So we don't think that the Fed will be raising rates anymore this year. But as I say, we do think that the economy is on essentially a razor's edge. When we start our forecast meetings, recently at least, we've been asking the group, there are 6 of us that participate, asking the group, what is your outlook in terms of the possibility, the probability of recession? What are the odds that you put on recession over the next 12 to 18 months? And there's a lot of disparity in viewpoints. So at one end of the spectrum, we have one of the participants at 75% probability, At the other end of the spectrum, we have at least one participant in those meetings that's at 45%. So that is unusually large in terms of the disparity in those points of view. But I think the bottom line is it's a reflection of a lot of uncertainty, and whether we're right or wrong, right being that we sidestep recession, wrong being that we're in recession, that it would be a relatively mild recession, not very deep and not very long. The Fed has announced that they intend to put 1.5 million folks out of work. We've been surprised by job market resilience and just the strength of the labor market generally. In our previous forecast, we actually were forecasting recession. We're not anymore. But we're pretty close. So, that kind of sort of lays the table for what to expect in lending and borrowing. As I say, we're thinking of a general return toward normal. So 7% growth, not 20% this year, and then an increase closer to 8%, a little bit of an increase next year as we sort of work our way through the expected slowdown.
Quickly on the banking issues, is that primarily consumer confidence, or is it different ways banks are behaving in response to it, or where are those impacts coming from?
Well, the biggest impact, as I mentioned, is coming from banks that don't have a lot of liquidity and that are thinking, tough times lie ahead, that are pulling back. They're, tightening their underwriting essentially and making fewer loans. And so by extension, that means lower economic growth, more than likely, more obvious hits to the job market, higher unemployment. So there's that. It's this idea that bankers are behaving differently at the moment. But the other big concern, of course, is that confidence is contagious, as Vince Lombardi said, and so is lack of confidence. So this could turn on a dime. And what concerns me is that the defining characteristics of the current banking troubles are the combination of a material weakness of some sort. That might be a field of membership issue, like a concentration in one industry like tech, which tech declined in equity markets by 30% last year. So some of those banks had a tech focus, as you know. That field of membership issue is appeal for some. Obviously, all depository institutions have investment portfolios. Most of those investment portfolios consist of fixed income securities. For many banks, they loaded up on lots of longer term fixed income securities. And when market interest rates go up, just mathematically, the value of those fixed income securities decline. And so financial institutions generally are sitting on investments that have unrealized losses. But there are other material, I think, concerns of various stripes that come into play. So a material concern on one hand, and then on the other hand, a large exposure to uninsured deposits. Those are two things that have been driving these challenges in the banking sector. We looked at the data, and I think anybody that looks at the data ought to continue to be concerned, because at the moment, or at least using December data, the most recent data that we have, December from 22 data, there are 800 banks in the United States that report that they have uninsured deposits of 40% or more relative to total deposits. That is a massive exposure to uninsured funding source. Those banks, those 800 banks, have collectively $15 trillion in total assets. And so they represent almost 2/3 of the total assets in the for-profit banking sector. Now, again, confidence is fragile. And if you have a whole bunch of depositors that aren't insured and they perceive that your institution is at risk, they're not going to wait very long to take their money out of the institution. And so it has, I think, certainly the risk of becoming a big thing. At the moment, things look pretty good, but I just am very concerned about animal spirits, if you will.
Have you seen something like that since you've been in the industry, or?
Well, I grew up in the savings and loan industry, so I saw it on a daily basis for about a decade. Yeah, and of course, the movie It's a Wonderful Life, although it's a movie, it's fiction, it does, I think, portray pretty well what has happened historically. And the difference today, of course, is that social media plays a large role in spreading the current feeling about the situation very rapidly. And so, we have podcasters and bloggers and influencers that seem to have strong opinions, not simply about the industry generally, but strong opinions about individual institutions. You have, at the moment, there has not been any ban on short selling, and so opinions, whether they're based on fact or not, get out into that marketplace, and people start making bets, and that can change the situation very, very quickly.
Yeah, things happen rapidly these days. Back to more of lending. So after last year was a massive year, it was kind of inevitable it was going to drop a bit, right?
Absolutely. Yeah. And especially with rates increasing as quickly and as far as they've increased.
I guess why don't we start with housing? I know that's still hot and high interest rates, high prices. What are you seeing in that area right now?
Yeah. So this is a really important question because home loans represent about half of credit union loan portfolios. Big deal. Home lending was a big driver of the overall growth in credit union loans over the last several years. And as you know, home prices have come up very significantly over the course of the last several years. Actually, because home lending was so strong, especially in 20 and 21, credit unions were recording really significant gains on sales of those fixed rate mortgages into the secondary market. So credit union ROA was quite high as we were experiencing and recording those gains on sales. And so with mortgage rates now on a 30-year fixed around 7%, the overall affordability has dropped dramatically. In fact, the National Association of Realtors is estimating that affordability today is at a 37-year low. So that means that demand is quite low. It's not just interest rates, it's prices, of course, and it's also, the idea that income has not kept up with inflation. So that combination of factors has led to the situation where it's tough for a lot of people to get mortgages. Now, the people that can afford to get mortgages, more than likely, are sitting on 3% mortgages at the moment, and so they don't have a strong incentive to go out looking for new houses when the finance rate's going to be closer to 7%. And then we also have, as you know, some pretty significant and long-standing supply issues in the housing market. And that's keeping those price increases relatively high, even though demand is low. Now, for perspective, I would say one of the places I look routinely is the Trade Association for Mortgage Lending, the Mortgage Bankers Association. They've recently updated their forecast, and there are two data points I think that are really important. The first one is what they expect in terms of new home sales. On the new home sales front, they're expecting overall a 2% decline in new home sales this year relative to what happened in 2022. Now that is important. Now, new home sales represent about a third historically of total home sales, but that's an important number because the new home sales is the primary driver of economic growth. When we think of economic growth, it's like the new things that have been built, right? There is a little bit of an effect in the existing home sales arena. You move into an existing home and you maybe want to get new carpeting or swap out some appliances or something like that. So there is an effect. But the really big effect on GDP is in the new home sales arena. So that 2% decline works into it's part of the calculus when we're thinking about how fast is the economy going to grow this year. More broadly, if we put new home and existing home sales together, in that case, the mortgage bankers are suggesting that we're going to see an 18% decline overall in sales. So, that has really significant implications for credit union mortgage loan growth. Now, that's the purchase money market. I'm guessing in a slowing economic environment, we will see more people tapping into home equity to kind of get through difficulties and avoid major hiccups. And so I won't be surprised, if you're looking for an area of the market that's going to be relatively strong, it would, I think, be second mortgages, and more importantly, I think home equity lines of credit. So existing lines of credit that will be growing relatively quickly.
How often is a decline like that in whether the new home market or the overall home market?
That's a very good question, and I'm glad you asked it. I don't know the answer, but I'm guessing that probably the last time this is not bringing me too far out on a limb, but you probably have to go back to 2008 to see something of that magnitude in the overall market. Yeah, but let me be clear. We're not expecting a replay of the financial crisis. Prices are high, and we expect those prices to sort of self-correct over time. We are leaning more toward the idea that the bubble that exists in housing is going to slowly deflate rather than pop. And there are a bunch of reasons for that. The primary reason is we just did not see the level of speculation in the housing market over the last several years that we saw in the build-up to the financial crisis. That's one thing. I think, going into the current slowdown, we see a lot of home equity. We see a job market that's quite strong. Consumers are just in way better shape today than they were back as we entered the financial crisis. Looking at debt to income, for example, in 2007, the debt to income ratio in the household sector was 125%. So that meant, if you look at people's take-home pay relative to their debt, that it would take basically a year and a quarter of take-home pay to pay off all the debt. That's what that means. And today that ratio is not near 125%. It's like 90%. So we've been in a broad deleveraging event in the household sector since the financial crisis. And the exposure to debt relative to income today is about where it was pre-pandemic. Very, very low. The other part of that equation is that if you look at debt payments, we had this massive refinancing event during the pandemic, talk about all that 3% 30-year fixed rate mortgage paper. That refinancing event gave consumers the opportunity to refinance all of their high rate credit into their new mortgage loan. And so if you look at the Federal Reserve data today on the debt payment burden, the monthly payments that people are required to make to satisfy their debt obligations, that debt payment burden is, if you abstract from COVID, and I'll tell you why in a minute, but abstracting from the COVID event, that level of debt payment burden is at an all-time low. And I abstract from the COVID event simply because during COVID, there was this massive, I don't know what it was, $7 trillion in federal stabilization and whatever you want to call it, support for the household sector. So that there was a denominator effect to that ratio, debt payments to income, debt to income. Income went way up. So the denominator became very large, and that caused the debt payment burden to decline very significantly. And then after a quarter or two, after the payments were over, it rose back up to kind of pre-pandemic levels. So at the moment that it's at an all-time low, and I think that's very helpful. And it's a direct reflection of the idea that households will be more resilient going into any sort of downturn than they were back then.
So correct me if I'm wrong, are auto loans in a bit of better shape than housing loans, or?
Yeah, I would say a lot better shape relative to an 18% decline, I guess. So we do have an issue, though, with affordability in the auto industry as well. So Cox Automotive, I think in partnership with Moody's Analytics, has been for the last 22 years calculating automobile affordability. And again, it's interest rates, it's prices, and then, by the way, the price of a new automobile loan at the moment has reached an all-time high, $50,000. So they've been tracking affordability for 22 years, and they report that at the moment, automobile affordability is at the lowest level it's been in 22 years. So since they began measuring it. So if we look at the Cox Automotive estimates of what the market's going to look like, they're projecting that new automobile sales will be slowing, but growing at a rate of about 3%. And again, new autos are that component that really help boost GDP if they're growing strongly. So it's 3% growth. It's not real strong growth, but it's decent growth, especially against the backdrop of a lot of the supply chain disruptions that we've had previously the last couple of years. Those are not gone by any stretch, but they're not nearly as obvious. And so that's helpful in terms of that overall sales equation. And again, for context, autos represent about a little bit over a third of credit union overall loan portfolios. So very important component of what we do. Cox is estimating the overall market will grow by just 0.6%. So it's kind of a break-even forecast. So those two forecasts are not, especially rosy for credit union lenders.
Is there typically, I know things could change obviously this year, but is there generally a first 6 of the month versus last 6 of the month with auto loans, or when are cars being bought, I guess?
Yeah, on a seasonal basis, the really strong growth historically has been in the second and third quarters. And that's generally true of loans. Normally in the first quarter, savings growth is relatively strong because people are getting tax refunds and so forth. We do see in December is usually a pretty strong month, and mostly with unsecured credit. People are using their credit cards to, fund their holiday shopping and so forth. But then coming out of the holidays in the first part of the year, we tend to see a strong focus on paying those unsecured debts down.
Inflation, where is that at? And I believe you said you're expecting it will kind of get under control.
Yeah, I mean, it peaked out at about 9%, and, variously measured, it's a lot lower today, around 5% headline, lower than that using some of the other measures, closer to 4%. So things are headed in the right direction. They're just not heading there very quickly, which is what concerns us as economists, and I'm sure what concerns policymakers as well. But again, against this backdrop of issues in the banking sector and a lot of uncertainty related to the debt ceiling and the budget, I think the Fed is probably concerned about the implications of those things really becoming problematic.
Is there anything you're hearing from credit unions, or any way in which credit unions could adjust to the current landscape, or maybe to be prepared for the potential of a recession?
Well, let me just back up, because I did want to also mention that, if we're right and there's going to be a slowing in the economy and more people are going to be out of work, if the Fed is correct that they're going to put 1.5 million folks out of work to get inflation down, I mean, obviously that hasn't happened yet, but if it does, anything like that does happen, we will continue to see greater and greater demand for unsecured credit, both unsecured personal loans and credit card debt. We've already seen an acceleration in the growth of those portfolios. As you know, somewhere between 2/3 and 3/4 of consumers live paycheck to paycheck. A lot of people don't have money set aside in a rainy day fund, and so their fallback in difficult times is their credit card or an unsecured personal loan. So I guess it's good news that those portfolios will be growing. It's also not so good news in some respects. because those are mostly the most vulnerable of our members who rely on that. So, yeah, what can credit unions be doing? Well, again, from sort of laying the groundwork to answer that question, our starting point is that a lot of credit unions have significant concerns around liquidity. Loans did grow by 20% last year, and the loan-to-share ratio in credit unions finished at a very high level at the end of last year. So I think it was just a hair over 80%, probably close to 82% at the end of last year. If our forecast is right and loan growth comes in at 7%, savings growth comes in a little bit lower this year, loan growth comes in at 8% next year, savings growth closer to 6%. Essentially what we're saying is even though loan growth is going to be relatively weak, it's going to be stronger than savings growth, which means that if you're concerned about liquidity, if you're wrestling with the challenge of tight liquidity, you're probably going to continue to be concerned about it. Overall, our forecast, if you look at the, movement-wide averages, if our forecast is correct, we're going to finish, credit unions writ large, will finish next year, 2024, with a loan-to-share ratio that's very, very close to 90%. That's essentially loaned out. So what should credit unions do? One thing that, this is obvious to all credit unions, so it's not a deep insight, but, having access to liquidity is a very big deal. And especially if we want to continue to behave like credit unions, if we want to help people get through any economic difficulties. We are actually, if you look historically, we are financial first responders. We were chartered to help people get through tough times, chartered in the Great Depression to get people through the Great Depression. And so, it's in our DNA to remain engaged and to be a lot less likely than the for-profit sector to be turning people away. And if we're going to do that effectively in the current environment, then we need to do whatever we can to ensure that we have those lines of sight into liquidity facilities and the ability to tap liquidity to get our members through faster than they otherwise would.
Yeah, this is the times where those charters and those missions can mean something. So,
yeah, and I think so. The bottom line is that, to answer your question, that there is no, in my opinion, there really is no, magic wand or silver bullet or, the bottom line is to continue to do what you've always done so much better than the rest of the industry, the for-profit sector, right? Continue to engage in tough times. Turn to your mission and your purpose and double down on, we were chartered, to be blunt about it, we were chartered to use capital during tough times. And in the for-profit sector, there's a fiduciary responsibility to protect capital in tough times, a fiduciary responsibility to basically, maximize returns to shareholders, right? That means either increasing the amount of money you're making or trying to reduce losses. And so that's what they have to do. That's not what we have to do. We have to do the exact opposite. And so, credit union professionals understand that implicitly. And I'm just saying that out loud because as a board member of a credit union, I know that board members become very concerned about the idea of maybe using capital to get through tough situations. It takes a long time through retained earnings to build capital. And so the idea of using it is something that we take very seriously, but it's certainly something that we should consider if the need arises.
Well, that was a pretty good message there. Is there anything else in the forecast that you want to point out or anything you want to wrap up with?
I could talk about this stuff for hours, but I will say, one thing that we didn't touch on is asset quality. And against the backdrop of what I was just talking about, it's important to think a little bit about asset quality and maybe talk a little bit about that. And the main thing to remember is that we are forecasting a pretty significant deterioration in asset quality, meaning that both delinquencies and net charge-offs will be rising and rising more obviously than they have been in recent months, if our forecast is correct. That's the bad news. The good news is that our starting point, as recently as the middle of last year, was delinquency rates and net charge-off rates basically at modern day lows. And by modern day, I'm going back to the early 1980s. So if you look at that modern record, neither of those statistics had ever been lower, and they've been rising modestly over the last 6 months or so. They will continue to do so, but I'm pretty sure our baseline forecast has those numbers settling in, not only at the end of this year, but at the end of next year as well, settling in at rates that are below the long-run average, or close to the long-run average. So I wouldn't necessarily characterize the forecast as a reversion to the mean, but things will look more normal over this forecast horizon than they have in the last couple of years.
It sounds like there might be some more answers or developments by the time you meet for your next forecast, huh?
Well, we always hope for that. I don't know if we ever
or
really
new
get
questions,
to that point. Yeah. It's new questions mostly, yes.
Well, great. That's all I got for you. I don't know if you have anything to add.
People, if they're interested in following our thought process, we have a pretty robust summary document on the website, www.cuna.org/economics. There's a summary, like a table summary of both our economic and credit union forecast, and then more importantly, a narrative behind what we're thinking and how we got to that point, as well as, I think a real helpful part of it is we have a cover page that talks about how our thinking has changed over the course of the last quarter and what developments we're especially concerned about.
Thanks for listening to the CUNA News Podcast. Subscribe to the show on Apple Podcasts, Spotify, Google Podcasts, and Stitcher Radio.